Welcome to the Seattle Investors Club podcast with Julie Clark and Joe Bauer, where we share the nuts and bolts of real estate investing from our 20-plus years in the industry. Sit back, relax, listen, and immediately take action. Are you ready? Here we go.
Welcome to another edition of the Seattle Investors Club podcast. My name is Joe Bauer, and I have my co-host, Julie Clark. How you doing today, Julie?
All good over here, Joe.
Oh, yeah. And today we have Scott Price from Bomvolo Real Estate Investments. Scott, how are you today?
Doing fine. Thanks for having me, Joe and Julie. I appreciate it.
Oh, yeah. We love having you on the podcast. We've had you at the club before, and it was fantastic. So I'm excited to dive in today and hear more about you. And that leads me to our first question. Really, Scott, how long have you been doing real estate investing, and how did you get started? So like this kind of first formal question for you, just to let people know who you are.
Sure. Yeah, I had a very brief touch with real estate investing right after college, and I wouldn't consider that to be part of my real estate investing. That has been going on for about 14 years that I've been actively investing. Started out in a somewhat unique development deal, and then rolled that into multifamily immediately. And since then, I've been gradually growing my portfolio with a combination of multifamily, some singles, and then got into some office, medical, and retail as well.
Okay, really interesting. And what did you do before real estate?
Yeah, well, actually, I've mostly been in program management and team management positions, primarily in technology companies. And for the past 14 years, while I've been actively investing in real estate, I've mostly been in those roles as well. In other words, I wasn't full-time in real estate until just recently. I actually gave my resignation letter. I'm officially full-time in real estate now, and grew my portfolio. Yeah, exactly. Very, very happy about that.
Nice.
And I got to the point where we were completely covered and comfortable with me leaving my prior job. And actually 3 years ago, we had set everything up so that my wife also left her job at the time. So she's been full-time in it for 3 years.
God, and you're still married.
Yeah, actually, yeah, it's actually been going really well. And we have a specific division of responsibilities that goes to each of our strengths, and it actually works really well. We work at home together out of our home offices, and I've been doing that for 3 years now.
Great, because we're going to have you back on the podcast to tell us all how a husband-wife team works effectively, efficiently, and stays married. I think it's a good topic.
Yeah, sure.
Actually.
And Karen can come on board for that. You can have
For sure. That's a great topic, don't you guys think?
Yeah.
There's a lot of husband-wife teams out there. So, Joe, mark the calendar. You guys, let's get that one on the books. That'll be our follow-up podcast after we crush this one today.
Definitely. One of the cool things that Scott said was that they focus on what their strengths are. And that's something that Julie and I always focus on ourselves, is focusing on your strengths and not trying to do the same thing as the other person. And then you get a lot more done.
So, Scott, I have a question for you. Now that you have quit the old job, do you sleep in the morning, or are you?
I get better sleep. Let's put it that way. I don't sleep in, but the big thing is that I'm more in control of my time. It's not that I'm completely retired and don't do any work. I obviously am working on my current portfolio and intend to expand it. But at the same time, I'm not working two jobs. So like I was for a while, where I was working a full-time job and then in the evenings and weekends working my real estate job, while at the same time my wife was working full-time during the day on our real estate business. And now my time is just expanded so much, and it's not just about real estate, of course. It's I'm more available for my family. We have an 8-year-old daughter, and doing things with friends, and we're building a home right now, so I'm available to work on that. And hobbies are coming back to me that for a while there really had been put on the back burner, and have some things in the background that I want to do that I'm already restarting. And so it's a really really good space to be in because I'm still active and can actually intend to be even more active in real estate investing, but it's on my own time and own schedule.
Exactly. And you know what? I have twin 9-year-old girls and you have an 8-year-old. It's such a good age. They are starting to be fun. They can carry their own luggage, they can, it's to me, I am in the same mode you are. I'm in let me get some money in the bank and let's hit the road traveling. I think I heard you say one time that you like to take a month off and just go traveling. And obviously with a job, you can't do that. But now with a passion, and you've already paid your dues, and I call it rites of passage, if it, rites of passage, you got to go through that double timing it, slogging it all out. And then you keep your head down and you come up on the other side and, oh my God, is life beautiful or what?
Absolutely. There's a combination of basically delayed gratification. In other words, we basically made do without of some things that we could have done and spent more money on and all that. But early on, we said, no, we're going to invest our money back into more properties. And then after a period of time, that snowball of properties and more income and more net worth and things like that keeps growing to the point where it grows on itself. And then that's a point when basically we're at right now, but that's also a point where things become more comfortable, and then you can even grow the business more and it just gets bigger and bigger.
Right. I mean, so you went you skipped all the flip this house stuff and you went straight to, what I tell people is flipping houses is a fee-based business full of tax problems and ordinary income, right?
Right.
That's great for when you're getting started to stockpile cash. Then you take that cash and you buy multifamily or income producing properties. If anybody takes anything off this podcast right now, other than how smart Scott is, it is that you are working and flipping houses. I'll tell you, you're going to regret it. You're going to be like, oh my God, I'm so glad she said that so I can think about that now. Flip houses to get a stockpile of cash. And when the market corrects, go buy the hell out of rental properties.
Completely agree. And the model that I've always thought is interesting for other people, again, it's not my model, but for other people who might do flipping, is to also, as they're flipping, to look for that occasional one that they may keep along the way. As they get a really good deal and they flip one, they flip two, they flip three, and the fourth one they keep, and they flip 1, 2, 3, and they keep
exactly
that kind of thing. So
right. That's right. Like set a rule, a rule and a goal that every fourth one you keep or whatever, right? Or always ask for that seller financing. You never know when somebody's going to say yes.
Sure. Or one that just cash flows very well from a rental perspective. And
right.
In other words, looking at it, not just market value comps and things like that, but if one in particular stands out that it cash flows well, then hey, that's the one, that's the one to keep.
Exactly. So let me recap here. So you've been doing this, 14 years, you said?
Correct.
And you went straight into the multifamily pretty much.
Mm-hmm.
And you left your day job in the tech world, right?
Yes.
Am I right?
Mm-hmm.
Tech world behind. And you are now investing in multifamily, maybe some commercial office and medical product and some retail and so forth like that. Does that sum it up pretty good?
That does. Mm-hmm.
Let me ask you, do you have a favorite book like on multifamily investing, or a favorite podcast aside from ours after this? Wink, wink.
I have listened to every one of your podcasts. I enjoyed
them. I know we all get educated, and even if people are doing well, even the top, I'm sure even Tony Robbins has his go-to mentors and educators. Of course he does, right? So who are your favorite podcasts about multifamily or commercial, or any books that you feel that you can share with our ever-growing audience here?
Sure. Well, of course, there's this podcast, and then the other ones that I generally listen to are the Bigger Pockets podcast, the Michael Blanc apartment building podcast, and Old Capital, which is actually one that's based out of Texas, and it is very Texas focused, but it has a lot of really good information. It's all around apartment buildings, and so it tends to be very informative, not just to Texas. Yeah.
Awesome. I haven't heard of that one. I'll check it out. Old Capital.
Old Capital, right. Yeah,
Cool.
Basically they're lenders, and they interview people that they work with, and it's very informative.
Nice.
And as far as books, I've read a lot of books, and I think that's really important for anyone to do. And my perspective on books isn't necessarily a specific book, but it's actually your mix of books. And what I mean by that is, when I first started, I was reading a lot of real estate books, and that was good. And they were all generally about the mechanics and the terminology and the processes going all the way from beginning to end on how to purchase and run multifamily or whatever the asset class is. And then after a while, I would occasionally hear about a recommendation for non-real estate books, but they helped a real estate business. And it became apparent after a while that there were really three categories of books that I was reading. And what I do is I actually skip between them as I read books. So I read real estate books, as I mentioned, and then I read general business books, which are not specific to real estate, but can help me run my real estate as a business. So best practices from a business perspective. And then the third one is what I would call, in general, personal development, mindset kind of books. And as I've gone over time, I've really realized that the mindset books are the most important books that I read. And the business books that I read help me set a broader structure in terms of how I approach my investing as a business, not just as an individual property, and how I'm going to scale up and things like that. Those are those kinds of books. And then the real estate books are always informative, just to help me on the mechanics. So I literally go between each of those. And when I've read a real estate book, I generally am looking for my next book to be a mindset book. And then I flip back. Those kinds of things.
What, share with us a mindset book that you like. I got to tell you, before you tell me that answer that you just gave us is one of my favorite responses anybody has ever given us on a podcast. That was awesome, dude. Right? Holy God. Joe's probably over there doing push-ups right now. He's so happy with what that response.
I'm like, Scott, I didn't know we were so alike in our reading style. It's fantastic.
Yeah. So lay it on us. What do you got on mindset books? Because we can all find the real estate, but everybody talks about that stuff. I'd love to hear it.
Sure. Yeah, there are a lot out there. The ones that come to mind would be books like The Magic of Thinking Big by David Schwartz. Also some around essentially habits and basically running your day effectively. And some that come to mind for that are Mastering the Rockefeller Habits, that was written by Vern Harnish, and The 7 Habits of Highly Effective People. I'm sure you've heard of that one, very famous, Stephen Covey. And then The Miracle Morning is also a very interesting one by Hal Elrod, just kind of how to start your day in a very productive but repeatable way to set you up for success for the rest of the day. And then other ones that come to mind would be things like the One Thing by Gary Keller, and just really focusing on what's important, and Getting Things Done by David Allen. That's another one that's really oriented a little bit more at the task level, but getting your life organized and what you want to do. So things like that. Those are ones off the top of my head that I've read a lot more than that, but at the same time that kind of genre I think is important. And then on the general business books that are not specific to real estate, but are really fundamental to scaling up a business. Some that come to mind would be the E-Myth Revisited, the 4-Hour Work Week, Think and Grow Rich, and another one that I really liked was The Millionaire Next Door. And that's not necessarily business per se, but it's more lifestyle. It's just kind of, again, teaching how to think and truly be a millionaire, not just look like one. So
that is spectacular. Joe, are we able to somehow put a link or something to Amazon Books on the podcast for hooking up people with all this stuff easily?
Heck yeah, Julie. Everybody can find all of these show notes that Scott is talking about at seattleinvestorsclub.com/27. That's seattleinvestorsclub.com/27. There will be a list with links and all that fun stuff.
Awesome. Because I am headed out for spring break. I don't know, Scott, you got an 8-year-old. Spring break is coming up.
Mm-hmm.
And you have just required me to extend our trip by a few days to add on some of these books.
Oh, great. Hey, that's a good thing to do. Good thing to do during your vacation.
Heck yeah. Well, that is awesome. So I guess we can wrap it up now, guys. No, I'm just kidding. That was spectacular. So thank you for all that info. I might have butterflies in my tummy. I'm so excited right now. So I'm going to get back to the multifamily or the investing in commercial and other buildings. So do you prefer multifamily investing over other types, like office or, other commercial, medical office or retail? I know there's a big buzz right now. The new construction of apartments is starting to get, at least in our area, a little saturated. I know some of the big developers are looking to repurpose retail centers that have better higher and use zoning, maybe. Some of the mid-sized retail strip malls that have, a good, size footprint to them, but not like, major mall, even though they are redeveloping Northgate Mall. What's your favorite out of multifamily, medical office, straight up office, or retail?
My favorite is multifamily. However, I do invest in the others on a very selective, opportunistic basis. And so I really like multifamily because there's so much at a macro level that supports multifamily as a long-term investment. And like you said, there are certainly pockets, including Seattle, where there's the high possibility of overdevelopment or getting saturated, or if things go down, then rents may go down, things like that. I, in general, invest in smaller markets, and I'm still in Washington State, but at the same time, smaller markets that do not have as much development going on yet have a lot of demand. So I always start at a very high level and start with the actual town or market itself and decide if I want to invest in it, and then go down from there. So the supply and demand in terms of the demographic shifts, there's at least with some people, there's a renter culture that is somewhat expanding. I'm sure you've heard that the home ownership rates have actually gone down, although it seems like millennials are now getting to an age where they're getting back into buying homes. So that fluctuates. It goes up and down. But there is an expanding base of people who have two things going on. One of them who just want the convenience of renting. They don't have to repair things. They don't have to put in their own reserves when the roof goes and they have to replace it, and those kinds of things. There's that segment. And then there's also the affordability issue, and rentals in general are going to be more affordable, not only in terms of the lack of a need for a down payment, but also just with the high prices right now. So that's an ongoing thing in support of multifamily. And then on top of that, there's an expanding population in a number of areas, and there's a lot, not just on the single family side, but also on the multifamily side of an ongoing need, and there's not enough being built in general across both those asset classes at a national level, at a larger level. And that's a good thing to be in. On that side of the supply and demand equation, you want to be in something where you're on the supply side when there's high demand and growing demand. So because of that, I generally prefer multifamily. When I'm opportunistic about office and retail, it's usually because I'll always buy something, except for one. I made one exception just because it was incredibly inexpensive, and it was a really good deal. But other than that, I've always bought office and retail with an existing, really solid tenant in place, longer term lease, and also I'm always thinking about, you really got to think about it in office and retail, is who's your next tenant, even if it's a really solid tenant. they may not be there. And it's, which is very different than multifamily. You want to make sure the demographics and the supply and demand supports multifamily, but you're not thinking of the specific who's going to be that next tenant. And you really got to think about that in office and retail. What kind of business would be there? Otherwise, you run into the risk of either office or retail sitting vacant for quite a long time. And that's one big difference between multifamily and office.
Right. The cash flow model is more fluid on multifamily, right? You get into, I've also owned office and retail myself. And you get into leasing commissions on turnover, tenant improvements, and all that stuff. Especially in retail, you want to avoid those specialty build outs or having to contribute to the TIs. It's like when the building is full and the tenants are all great and everybody's in place, the cash flow is awesome. But you got to really plan for the future on lease expirations. You got to really do tight asset management to pay attention when your loans are maturing to make sure none of your big tenants are also having their lease coming up at the same time. It's so it doesn't affect if rents have gone down for some reason, like has happened in the past for people, that all of a sudden, you put your loan on, 10 years ago, and 10 years go by, or however long your loan term is on office or retail, and for some reason rents have gone down, or something, or since you put your loan on, and now you need to get a new appraisal for your refinance, but your rents are lower. You could get whacked, right? You really got to understand the dynamics of, I'll say, asset management on those bigger assets. I spend a lot of time in that world myself. I enjoy it. I like to geek out on figuring it all out, but it is a different animal. Multifamily is more, I feel, more fluid, I guess I would say, with the cash flow, right? More predictable, I guess I'll say, right?
Right. And the interesting thing about office and retail is you not only have to project out into the future, which you do with multifamily as well, but you've really got to project out in terms of what's happening around the particular property with other like buildings. And it's not just the simple competition that you may get in a multifamily where, okay, this one place is advertising at $750 and it's a similar square footage and that kind of dynamic. It's more of, okay, well, there's a coffee shop over there and there's a coffee shop over there, so I'm probably not going to get a coffee shop here. That kind of thing. And you've got to be very specific in terms of thinking of what could come and replace it. There are some benefits though, and that's the reason why I do consider it. For instance, several of our properties are triple net, and for those who haven't heard of triple net essentially is where the tenant is paying for the insurance, they're paying for the property taxes, and they're handling their own maintenance. So if something goes out on, let's say, the water heater, they actually take care of it. So it can be pretty hands-off. And the other big benefit is it can be very long leases. In general, multifamily, at most, you're going to have a 1-year lease in general. And however, with commercial, office, and retail, 5-year leases are pretty frequent. I just, one of my properties just got a 10-year lease, for instance. And
Nice.
That's pretty convenient. Now, when that lease is up, then, if they don't renew, then I've got to scramble. But during that time, it's pretty low maintenance, low management, and easy to just do the classic, checkbook money kind of thing, or excuse me, mailbox money,
Right.
money kind of stuff.
Exactly. Love it.
Say, when you have a long-term tenant like that, Scott, do you have a timeline that you start renegotiating to see if they're planning on staying?
Great question.
About a year out, I'll start asking what their intent is. And about 6 months out, we'll really start getting very clear and start writing up the new lease if they intend to stay on. If they don't intend to stay on, then about 6 months out, I'll start actively getting it advertised and marketed. But if I know even earlier, a year out, I may start spreading the word at least with local commercial real estate brokers who may be able to bring in tenants, just so they know in case it's in the back of their mind, and if they have somebody who has a longer range need and not immediate, at least it's there, but then 6 months before, get real serious on actually ramping up the public marketing.
Yep.
Cool.
I'll say the one thing about investing in maybe markets outside of Seattle, let's say like the Tri-Cities or something like that, a little bit of a boom and bust. You got to be aware of the boom and bust nature of, at least in Washington or any, we'll call it second tier market, wherever you guys are located around the country, that has room to expand. When the times get hot, people go in and start building new apartment buildings, and then they overbuild it. Then there's an absorption issue that you just got to pay attention.
Yep.
Same thing in retail. You own like a retail strip center. Well, you better be paying attention. If the market's going well, or project forward, thinking about how long your loan term is going to be or what might happen, because all of a sudden, if there's room to build new product, new retail center, new apartment buildings, and you're in a market like that, people will go in because they get so excited, and they'll overbuild the market, and it will impact you because they'll start giving concessions or deals on their rent, and it'll kind of trickle downhill, right? You just have to be aware of that kind of second tier market investing, to always keep your eye on what's in the new construction pipeline before you buy something, so you're aware you don't get smacked and spanked around, where you get a temporary maybe you have to give concessions or drop your rent because the new kids in town are in their lease up. Does that make sense to you, Scott?
Absolutely. And yeah, it's very true. And that's one of the things that I look at when I'm looking in secondary and tertiary markets is, what is the local economy? What's it based on? What's its basically resilience or resistance to downturns? If it goes down, what might the impact be, and what would be left? That kind of thing. And like you said, also the pipeline, it is interesting that in some of these small markets, they get exactly what you're talking about, where they get some interest. There's very low vacancy, so people come in and say, okay, well, I'll go fill that need. But there are also others that have low vacancy, but at the same time, they're not as much on everybody's radar, and there is exactly the concern that you're talking about, because it's not even in some cases with the developer, it's also with the lender. And so some places they'll have trouble getting financing anyhow, so it acts as it's a balanced system, so to speak. It kind of helps prevent it. That doesn't happen as much in Seattle, where there's
right. You got the opposite problem in Seattle, where you're buying for appreciation at this point, not cash flow. Not cash flow, right?
Absolutely.
So, but I have some ninja ideas on how to take advantage of even that we're going to be talking about at Seattle Investors Club, and on some future tips of the day that we throw out weekly for you guys. If you go to YouTube and just search Seattle Investors Club, we have tips of the day dropping every week on little mini nuggets. And one of the topics I'll be covering in this next few weeks is how to take advantage of still being in the Seattle market and the low cap rates and stuff like that as a wholesaler and investor. We'll see how you guys respond to that, but I'll save that for another time. Let's see. Let me move on here. So you got your experience. You've been in the game for a while. What is your least favorite part of the investing in multifamily or commercial?
I really enjoy a lot of it, which is why I'm in it. There are a few things that from time to time can become a problem or become not as enjoyable. The one thing that pops to mind is, especially as I grow my portfolio, the financing is an interesting dual-edged sword. And what I mean by that, the financing process, and it becomes easier for me to get financing because I have a track record. All my projects have been successful. They can see that. And so I come in and it's not a question in the minds of the lender in terms of whether or not I can perform on the particular property and whether or not they trust that I understand it enough to buy it and run it for years. But the complexity of getting the financing as it gets more and more onerous. It's kind of interesting. They have more questions because there's more properties to have questions about,
right.
In my portfolio. So that's one thing.
We used to submit something called, with a huge portfolio, called the Schedule of Real Estate.
Mm-hmm.
And it was basically just keeping track on a spreadsheet, a schedule of real estate of all the assets owned, and whatever information a lender is going to require, you just keep that on your schedule of real estate and you update it quarterly. So when you go to buy your new building, you're not having to start from scratch and recreate. That's
right.
how we used to roll with that problem. I hear what you're saying.
Yeah, and we have that, and we have something along those lines. It's in Excel, and we have a whole bunch of columns, and we actually hide and reveal certain columns depending upon what the particular lender asked for. And
Exactly.
So we have that already. The complexity comes in after that of, okay, we got all these line items and it's when we purchased it and how much we bought it for and what's the estimated current value and what's the monthly payment, blah, blah, blah. And then, however, there's the follow-on questions, and that's where the complexity comes in of, okay, well, send us that. We want to see the leases for that office building, and we want to know more about the tenant and what is the condition of the building and things like that. And we get those kinds of questions.
Right.
And so there's the schedule and of real estate owned, but then there's the questions that come from everything on the schedule. So,
right.
Yeah.
But you know what? It's a good problem to have, isn't it?
Absolutely. It's part of the business. Yeah. For instance, right now I'm doing a Fannie Mae loan, and Fannie Mae loans have several advantages. They can be non-recourse, they can be assumable, and they can have longer fixed terms than most commercial loans. And so those are the advantages. The disadvantage is that, especially because they're non-recourse and partly because they're assumable, the depth of the process is a full-time job. At least it seems like it is.
No pain, no gain, Scott.
Exactly. Yeah, exactly.
Can you define non-recourse for our listeners who might not understand? I got what you're saying, but that's an important little nugget, that definition there.
Sure. So basically, for people who are familiar with let's say a home loan for themselves, it's going to be a loan that's full recourse to them. And what that means is they got the loan based on their income and their credit scores and whatever other factors the lender is looking at. But it's partly about the property and the value, but it's especially about your ability as the borrower to pay that monthly mortgage for that property that has some given appraised value. That's it for singles and buying single family homes. Then in the case of commercial loans, you actually get, in most commercial loans, most are still recourse, and meaning that if I have a commercial property and I stop paying the loan on it, I'm still personally responsible. My LLC is not only responsible, that might own a commercial property, but I personally, in my personal name, am also responsible for it.
And that's recourse.
That's recourse. Yeah, I'm going through the three different things. So that's recourse. And there still are a lot of commercial loans like that. When you get into commercial, they're looking more at the property and its income than the borrower, which is why I'm talking about this middle one, because as opposed to how I was describing somebody buying a home, they're looking more at the property than the borrower in commercial, but the borrower is still on the hook personally. Then the third group, which is the one I'm talking about here, non-recourse, that one, they still look at the borrower because they want to know that they can trust the borrower. However, they do not hold the borrower personally responsible for the payment of that loan. It's all based on the property's ability to generate income, and the income being sufficient over the long haul to pay for that loan. And if for some reason that particular property should go bad in some way, or the sponsor or the borrower, the person behind it, should stop paying, then it goes back to the lender. But there's nothing on the person borrower.
No personal guarantee.
There's no personal guarantee, and there's nothing on their credit report. There's no responsibility for that individual to pay it. The LLC still has to pay it, that owns it, but you just keep everything contained with the LLC and it
right.
all the liability.
Is there a minimum loan amount to be able to get to the non-recourse?
It depends upon the lender. Usually it's a minimum of $1 million or above. However, there are multiple scenarios, and there are multiple lenders, and there are multiple multiple deals that are out there, but it's usually $1 million or above, and that's on the low end. It's usually for things that are higher than that, and it also depends upon a lot of factors. If they're willing to do non-recourse in certain markets and certain asset types and things like that. So there are a lot of boxes to check as to whether or not they'll provide that.
So in a nutshell, if you are looking to buy multifamily properties and you are buying smaller buildings, right, and you're putting debt on those buildings, you should plan on and understand that those will be recourse guaranteed loans, unless you're getting some sort of awesome seller financing, or maybe you can get away with not having that. Is that fair to say? That
is. There occasionally there are exceptions with local banks that you may have an existing long-term relationship. So it's not 100% black and white, but for the most part, what you said is true. And and in the case of myself, for instance, even over a period of time, this is actually my first Fannie Mae loan that I've done, even though I've had others that are certainly in that price range, but at the same time, this is the first one that I've done, and it's been an interesting educational experience, and I would do it again, but it's, you definitely gotta work for it. And for somebody who, it's kind of interesting because it sounds nice and it's a nice to have, but for somebody like me, I've always paid my mortgages on every one of my properties, so it actually has very little practical value. But people like to have it just as it's almost like insurance and risk management. That's actually not the main reason I pursued this one. I pursued this one to get a longer term fixed rate, because the fixed rate on most commercial loans is usually 5 years, and frequently actually it can balloon in 5 years, meaning that after 5 years you'll have to pay off the mortgage. Now sometimes the same lender will refinance with you, but frequently after about 5 years on a lot of commercial loans, you have to have a plan. You have to, you either got to refinance with them or refinance with somebody else or pay it off all cash or whatever. And in other cases, after 5 years, it just resets, which means it stays with the same lender, but the interest rate changes based on an index like 10-year treasuries or something like that.
Right.
And so it just go in an increasing interest rate environment like we have right now. In 5 years, you have a higher likelihood of your interest rate going up, and that's why they do that, so that they have the chance to make more money in 5 years.
Heck yeah, everybody wants to make a buck.
Yeah.
Well, let me ask you. So let's take it down, step it down just a little bit, because there might be people listening to our podcast today, and we hope there are, that are just kind of dipping their toe or starting to focus on multifamily investing, that might be buying, the smaller buildings, maybe 10 units and under, or, I know that 4 units and under is a residential product, correct loan. But let's say somebody's buying a smaller building, or even like a 10-unit building. The question that they probably want to know is how much of the loan process relates, how does it work with their personal credit? How is that looked at as far as the process goes when getting a loan?
Yeah, they do. The lender will look at that, and again, they're more interested, as soon as you go 5+ units, they're more interested in the property and its ability to support the loan. But since there's a combination of recourse plus it's more of a smaller deal where they're really looking at, okay, how is this individual going to manage it? You're not when you have smaller properties, you're less likely to have a big team involved, and you may even have the classic mom and pop operations where basically they self-manage. They may even, might not even have a professional property manager. They might not have a maintenance person, things like that. So they're looking at the individual's abilities, the individual's background, and certainly their credit score, because it's at a lower loan level that's more analogous in some ways to a home loan. I mean, they wouldn't say that, but I mean, that's kind of, what's going on there. In other words, it's analogous to paying a home loan, except that you actually have an income stream coming.
What if the building, there's good debt service coverage, which means debt service coverage means that your NOI on the building is, let's say, your net operating income on the building is make sure I'm saying this right, Scott, like we'll say 1.25 times the amount of your debt service. So your annual NOI is 1.25% times higher than
1.25, 125%.
125% higher than your annual loan payment of your
just to clarify, so it'd be 25% higher, so it'd be 125% of your debt service, or your debt that you're paying on a monthly basis. Then it would be 25. You need to have your NOI, your net operating income, to be 25% higher in the example you gave.
Right, in order for the bank to be happy with calculating their loan amount and stuff like that, right?
So
exactly. It'll adjust if your debt service coverage ratio isn't hitting what the bank wants to see on their debt service coverage ratios, and that number moves around a little bit sometimes, then they will lower your loan amount until you hit it.
Exactly. And there are actually several other factors there that, again, don't really apply to residential loans. One of them is that they will do something called stress testing. And what that means is you may get a current loan at, let's say, 5%, but if your loan is going to reset with them in 5 years, or you might even get a shorter term, let's say 3 years or 5 years or whatever it is, they may then say, okay, how does it do if the interest rate resets to 6.5%, and there'll be some principal pay down by that point, but at the same time, how is it doing then? And they may, and I've seen this happen, they may actually say it doesn't meet their criteria based on a future potential interest rate. So that can actually happen as well.
Right. So in a nutshell, whenever you're looking at an apartment building deal, Scott, would you advise people? So let's say you're able to get it under contract off market. Ideally, that'd be awesome. Of course, on multifamily, maybe you're finding great deals in second tier markets that are listed or with brokers. That's fine too. But the point is, you're going to have like a due diligence period once you go under contract, right?
Mm-hmm.
Do you typically, you're experienced enough where you're underwriting probably your loan yourself. You have enough information, right? So experienced people, just like if you're flipping houses, you have your deal analyzer. Well, you're plugging in a loan amount as part of your deal analyzer on your assumptions, because the borrowing terms, that you can get with private money or hard money or whatever. Once you get rolling in the multifamily or commercial investing, you learn the same. You learn how to analyze your deals based on the loan underwriting. I would say even more so on commercial and multifamily, you got to back into the deal based on your loan that you can achieve.
Absolutely. Yeah. And that's really critical. I do that at a quick high level, even before making an offer. and I start with what the seller and listing broker provides. It's rarely realistic. It sometimes is, but it's usually either missing information that would really come down the line, or it's very optimistic, or it might even be real numbers. But for instance, if you have very low expenses, that's actually not a good thing in some cases. That might mean, okay, there's deferred maintenance, or that
and the lender is not necessarily, you get a pro forma from a multifamily or commercial broker with these low expenses, or maybe in reality the actuals are they're very low. The lender is not necessarily going to underwrite your expenses at that number.
Absolutely. Yeah. And that definitely happens. And when you get into larger properties, there's a range, but frequently whatever your gross income is, the actual expenses that you'll be paying are frequently at least 45%.
Right.
And, meaning you're only left with 55%, and that's before that's not including your mortgage. That's
right.
before your mortgage.
Do you have a rule of thumb on your expenses that you use for your underwritings? Let's just say not in 100-unit buildings, because that's a different animal. Let's say in a 10-unit building, would you use like 40%?
For smaller buildings, it really depends upon who's doing the management and if the owner is going to be doing any of the work.
If you're self-managing.
Yeah, if you're self-managing, then you could do at a quick, just rule of thumb kind of thing, 40%. Usually what I do when I'm looking at a larger building is when I see the gross income based on real rents, based on a rent roll that they've provided. So it's not just pro forma, but it's real rents. And what I'll do initially, just to say, okay, should I look at this even anymore, is I'll usually just cut it in half. In other words, 50%.
Right.
And there definitely are properties out there where the expenses are more than 50%. So 50% can be a good, real quick number to use. And then if it looks like, okay, well, this is in the realm of reason in terms of the return that I'm looking to get, then my next step is to actually do a line item analysis. And I'm never going to apply just a percentage on and say, okay, well, this is 45%, which is what it always is. I'm never going to do that. But initially, when something comes across my desk, so to speak, I'm going to do that real quick just to say, is this thing even worth looking at for a next step? And then I actually do have a complicated spreadsheet, and I got line items, and then I use rules of thumb for every element, and then I.
What does the lender use, which is almost even more important? I mean, there's what the lender uses so you can get your loan, which backs into what your down payment's going to be and how much money, and then there's the reality of what you can actually operate it at might be better.
Right. Yeah, they'll take into account a couple of things. They're almost always looking at T12, which is trailing 12, meaning trailing 12 months of income and expenses. Yeah. And there are actuals. They'll very rarely, although I have had, personally, I've had some experiences where lenders would take into account the fact that the property was not being managed effectively, the rents were under market, and they actually did add a factor in my favor, but that's the exception rather than the norm. And they're generally going to go on actuals. They'll even request, and I'll request actual Schedule E's. In other words, they'll actually request tax returns from the seller. And so people can put whatever they want in an offering memorandum or a marketing package, but unless they've doctored up their tax return, usually people are going to claim all their expenses, and they're going to try to minimize their income. So if their tax return says something different than the marketing, then you can ask the real questions of why exactly is that? And there's all things that people tap dance around for that answer, but it really brings out a much clearer picture. And then to answer your question directly, in terms of the lender, they will have their own rules of thumb, and they use that information, but they also compare it to their own rules of thumb. And that can come from the people that the loan officer works with in their group, and it can also come from some information that the appraiser may provide as well.
On the smaller buildings, let's say a 10-unit building, the lender's going to underwrite their expenses for whatever, a combination of reviewing everything and whatever their own guidelines are. Do they always, on the smaller buildings, I know on the larger buildings, when we're talking about Fannie Mae loans and stuff like that, they have a line item that they apply a minimum of a capital expense number per unit.
Mm-hmm.
Like it used to be 200. Maybe it's, bucks a unit that you would have to budget when you're underwriting your loan for a larger property that, the lender is going to include. Plus you're going to have that anyways, right?
Absolutely.
And that is beyond your NOI. That's after. Line item comes after your NOI would be your capital expenditures, which is like replacing appliances and replacing carpets and bigger capital, replacing roofs and things like that you can amortize. On the small buildings, because we don't want to get too ninja detailed today because of who our mixed audience here. But I'm curious for these people on the smaller buildings, do the lenders underwrite a capital expenditure per unit?
They'll take that into account, and they generally will. It'll depend upon. Actually, it depends upon external factors such as the reserves that the individual borrower has. In other words, they're less concerned about it if they can see that the borrower, meaning the person, because a lot of times
individual.
The borrower. Yeah, exactly. Because a lot of times the borrower on these loans is actually an LLC, but there's a person behind that LLC. And if the person has good liquid cash reserves, that goes a long way. It doesn't mean that it's a necessity, but if they don't have a certain amount of cash reserves, then the lender is going to be much more concerned about making sure that reserves are factored in,
right,
their analysis.
And again, why we're honing in on this, guys, is because in multifamily and commercial investing, really your loan, we're talking bigger dollars than just a house. Your loan is so important to understand that piece. You got to become a financing expert, right? Because it really dictates, your cash flow and your loan amount. It's you got to know this stuff. So, all right. Well, we're talking about financing. I could talk to you all day long about this sort of stuff. But let me ask you, Scott, is your MO like the value add play? So you buy something, you reposition it, you buy at one price, you got your loan, right? Your initial acquisition loan. Then you reposition it through some sort of value add, repositioning, raising the rents or increasing other income, lowering expenses, bringing your stellar management style. And then you, get a new appraisal and refinance and hold long term? Is that the MO?
Our general approach is we buy properties that are already pretty well, they've already got a pretty good occupancy rate already to start. So there's cash flow from the beginning. So we don't go in and purchase boarded up level of apartment complexes. We start with an existing base of cash flow. We start with a property that right off the bat will meet the minimums for financing, will meet the minimums for us. And then we're looking for incremental opportunities that are on both the income and the expenses side. And before we buy, I mean, there's obviously a whole bunch of opportunities out there to buy, and the ones that float to the top are the ones that have more incremental opportunities, such as below market rents. That's one we especially look for. We also frequently, we've had some good success recently with RUBS, ratio utility buildback, and those are those have been really good, especially in an environment like we have right now, where there's low vacancy and there's a lot of competition among renters and things like that. You've got to make sure that your market can support it. But let's
just tell them what he's talking about when he says RUBS is a utility bill back program. It's to bill back the water, sewer, garbage, and sometimes even, at least in Seattle, the trash to tenants. You don't have to have your building sub-metered separately for the units. There's services that you can hire that will manage that process and invoice the tenants for you. And it's a very, very good, I mean, what is it? Could be 25 to 60 bucks a unit or
Absolutely.
add on. Boom. If you just buy a building, I mean, I wouldn't think that's enough to just, add enough value in your deal, but it is sure a quick, first look thing to add on as a value add increase to your properties, right?
Oh, absolutely. In terms of cash flow, it becomes basically cash flow that does not require new carpeting and fix up and expenses, things like that. It's kind of invented out of thin air kind of thing.
And it can apply to every unit, not just the
Exactly.
units that need an upgrade.
Exactly.
Across the board.
Yeah, it's a big benefit there. That plus the market rent options are both nice because by themselves they don't require a capital outlay to improve the property.
Right.
Now, we always improve our properties in some way. We generally prefer I would say B and C, which is, for those who aren't familiar with it, you usually have A, B, C, D level of quote quality of properties, and the value and the return now, and usually actually, but especially now, is usually tends to be more in the C and a little bit in the B, because the people are just paying way too much for the A luxury properties, and on the D you can get a good return, but they can be very problematic and high turnovers and lots of damage when there is turnover and things like that. So there's kind of a sweet spot in there between the extremes.
I always used to think, I'm not, I hope this isn't politically incorrect, but I'll say it, the blue collar properties are the best, that's, I don't know if that's politically incorrect. I apologize if it is. I'm not trying to do that, but I mean, like you said, the B's, or taking a C to a B.
Right. Exactly. And that also points to another thing. We did that recently with one of our properties where we were specifically looking not just at the property, but we were looking at the path of progress around it. And we purchased a property that was sandwiched between two up and coming neighborhoods, and it was in a so-so neighborhood right in between, but it was very clear that the up and coming neighborhoods on the side were expanding, and they were expanding in, and we did benefit from that. And so we look for those kinds of macro level opportunities as well, where the market itself will help us to increase it on the income side, and not just on the expenses side.
Oh my God. I could go on all day like this. This is probably one of the longer podcasts we've done because I'm just geeking out. I feel like it's just you, me, and Joe hanging out here, and I'm geeking out personally here. Thanks, guys, for letting me have some fun today. So, Scott, just to start headed down the path of wrapping up here, because my sidekick buddy is getting hungry and I think needs to take a pee. Right, buddy? Okay, so that's my Labradoodle buddy. He's our sidekick here. So what, are you interested in any out-of-state investing, or are you interested in, joint venturing with anybody these days? I was going to talk to you about syndication, but I think we'll save that for another time because it's a higher level topic, and we're running out of time here today. So what I want to know is, if people have deals that they are interested and need help on, how can they reach you? Or are you interested in partnering, or are you interested in mentoring? What's your spin on all that?
Sure. So actually, to answer the first question about out of state, we have purchased out of state. We actually sold our out of state, and we're going to get back into out of state when the market turns. Right now, what's happening is the cap rates are going down nationally, and the benefit of going to some of the traditional cash flow markets out of state are less than they used to be. So there's still an advantage, but there's less of an advantage than there used to be.
Which out of state markets would you say you had your eye on?
Well, let's see. I've been looking at, we purchased in Memphis. We had a 40 unit in Memphis that we just sold a couple months ago. And then Pittsburgh, Columbus, and Atlanta. Those were our top four that we were checking out.
I always thought that Memphis would be oversaturated with all these guru types out of Memphis. I'm sure they do a great job. I don't know. I haven't checked them out, but it seems like everybody's going to Memphis because that's part of where they're at.
Yeah, well, it can have good cash flow, but you got to really know not just the market, but the submarket, and literally it can be down to which side of the street you're on can make a difference. Right. So you got to be really careful in Memphis. So
right on.
But at the same time, it was interesting. We made some good money there, and kind of got out, and we were redeploying that money into
got out while the getting was good.
Exactly. Yeah. And so to jump to your other question, we certainly are open to partnering with other people, and very interested in that. We're actually very, very active and interested buyers. It's a hard market to buy in right now, and if people have strong deals, we're certainly very interested to look at it. We're ready to jump in at any time. So,
well, if people have deals they want to send you and run by you, and maybe even partner with you, where can they reach you?
Sure. Two ways to reach me. One of them would be there's various contact information on my website, which is bonvolo.com. And that's BON as in November, V as in Victor, OLO.com. Or you can reach me directly at my personal email address, which is Scott, SCOTT, @bonvolo.com.
Awesome. I've lacked on one thing today. I like to crack jokes and goof around, and I've been so interested in what you're saying. I forgot to bring the funny today. I got to tell you what, this has been awesome for me. Thank you just personally from me. This has been super awesome.
Likewise.
And great information. I hope you guys all realized how ninja and great information you got today, especially about all that financing stuff, which is so key to the multifamily and commercial investing. And so we got your back here at Seattle Investors Club, guys, and any questions that you have, throw them down below on the podcast. You can always reach me at Julie at SeattleInvestorsClub.com. That's JULIE at SeattleInvestorsClub.com, or my partner Joe. That's Joe at SeattleInvestorsClub.com. And we want to help you guys build your wealth and have massive success, so we all get the freedom that we're all after. So, Joe, anything else that we need to add here today before Buddy tries to bite me on the leg?
No, I just want to say thanks, Scott and Julie, as well. I've just been sitting back here taking notes myself. You guys are just fun to listen to. So thank you for that. And for all of those out there listening as well, the show notes are at SeattleInvestorsClub.com/27. I know there's just a ton of info in there, and we're going to have links and all that fun stuff at that, SeattleInvestorsClub.com/27. And if you enjoyed this podcast or any of our podcasts, we always appreciate a review on iTunes, which you can do by going to SeattleInvestorsClub.com/iTunes. We would love it. And again, Scott, thank you so much for being on the show. We really appreciate it.
Thank you for having me.
Yeah.
Awesome. Love it.
All right, guys. We will see you on another podcast.
Over and out.
Bye.
Thanks for listening to the Seattle Investors Club podcast. If you have questions that you'd like to have answered on the show, shoot us an email at info@seattleinvestorsclub.com. Now go out, take that action, and build that real estate business. Thanks for listening.